Good morning and welcome to The Street on BNN Bloomberg. I'm Roger Peterson. Thank you very much for joining us right now. Coming up on the show today, Hadiza Jatu, Vice President and Portfolio Manager at McKenzie Investments, will be joining us for the hour. Then in 30 minutes, the closure of the Strait of Hormuz is sending ripples across global markets, including Canada. And we'll be joined by Andre Sayre, Associate Professor at the Department of Management at the University of Toronto, Scarborough campus, and the Rotman School of Management. He'll be taking a closer look at the situation. And of course, we want to hear from you this morning on First Call. Reach out with your questions on the Bank of Canada, inflation, and the dollar. We'll have Hadiza answer as many of those questions as she can at the end of the show. The number to call, 1-855-326-6266. We'll open the phone lines in about 30 minutes. Our email address is firstcall@bellmedia.ca. Now, some of the stories we're tracking for you in the BNN Bloomberg newsroom. The G7 finance ministers are set to discuss a possible joint release of strategic oil reserves as the Middle East war drives crude prices sharply higher. The call was organized by France and could include coordination with the International Energy Agency. And release from global stockpiles could help ease supply disruptions that have pushed Brent crude closer to $120 a barrel. It's back down around 102 right now. Officials say no decision has been made, though. Prime Minister Carney and U.S. President Trump spoke Sunday afternoon. According to a statement from Carney's office, the leaders discussed the economy, developments in the Middle East, and trade relations between the two countries. Both agreed to remain in close contact. The U.S. Food and Drug Administration is planning to ease some requirements for drug makers developing biosimilars in a move aimed at lowering the cost of expensive biologic medicines. The agency is expected to reduce the need for certain studies used to prove the drugs match their brand name counterparts, potentially cutting development costs by about $20 million per drug. Officials say the change is part of a broader effort to speed approvals and increase competition in the U.S. market. And now our top line story, of course, oil has smashed through $100 a barrel as more major Middle East producers cut output with a standstill of tanker traffic through the vital Strait of Hormuz, choking off supplies to the rest of the world. You can see today it's up 12%. At one point, though, it's at 101.76, 101.75. At one point, it was up near $120 a barrel, first time since 2022. For more on this and the impact on the wider markets, let's bring in our guest for the hour, Hadiza Jatu, Vice President and Portfolio Manager at McKenzie Investments. Hadiza, thank you very much for joining us today.
Thanks for having me.
Not a dull moment going on right now.
For sure.
This. Your initial thoughts of what we've seen oil do today? I mean, it's already going through the roof, but today really seemed to take off.
Absolutely. And I think the news over the weekend was the appointment of Khamenei, the Supreme Leader's son, as replacement, and clearly showing that Iran's stand is going to continue to stay hard and fight back, rather than kind of coming back to the negotiating table. And I think that's exactly what we're seeing where oil is at now. I also think that there's some form of consideration around supply. Storage is getting somewhat overwhelmed. Production has been stopped in Kuwait, in Iraq. So all that really led oil prices to now reprice the risk of an energy supply shock that is going to be a bit more extended than we expected in the first place. Now, I always look at situations like this from a viewpoint of winners and losers. Mm-hmm. And as Canadian, this is actually a pretty good thing for Canada and for Canadian dollar, right? Canadian dollar is somewhat a risk-off currency that tends to sell off when risk is selling off, equities are down, Canadian dollar is down. But now with oil above 100, we're going to see recorrelation between oil and Canadian dollar, i.e. higher oil prices mean higher Canadian dollar.
And that's good. We were talking about this off air. That's good for now, but...
It's good until it gets bad. It's good because term of trade, Canada is the third oil producer in the world. As we know, about 5 million barrels that are exported, mainly in the U.S., 95% in the U.S. through the XL pipeline. So that's positive for term of trade. And I'm sure Bank of Canada, during their next meeting, is likely going to lift growth expectations. In the last MPR in January, they had penciled in about $55 a barrel, was significantly higher today. So that's positive from a growth perspective. But that means also inflation is going to creep up. and Bank of Canada, in that context, will not be able to cut rates. So that's where it gets tricky. The second consideration is when you have oil prices above $90, the study has proved that that's where chances of a global recession start rising because you're distorting demand, right? Oil is the one commodity that goes in every single thing we have. It goes in our cars, goes in producing building material, goes into even producing some commodities to the production chain. So that's pretty significant.
For the global recession, how big is the window? How long can we sit at 190? I mean, 100 at one point, it was 120 today.
Yeah.
How long can we sit around here before we start looking at it?
Not long. And you can see the response already with the G7 gathering today, trying to see if they can effectively float the market with oil from strategic reserve. I don't think we can withstand more than a couple of weeks at 100.
It's that tight, and that'll start triggering.
It is, absolutely.
How long can the G7, how much is there in their reserves?
I think it wouldn't be enough, right? We know already in terms of the reserve that they could be able to make up for a couple of weeks, but say that this is a sustained solution, they would be draining reserve very quickly. The Strait of Hormuz has never effectively been closed. It's been closed now for almost 10 days. And even if it's reopened, you're going to have a lot of time for oil to kind of filter through the economy again. And those reserves, as big as they can be, are not going to be sufficient to make up for that.
So it's going to have to rebuild. Now, we were talking about the Canadian dollar. Can Canada benefit at all from the situation in the Middle East? Or is our oil still a different beast from what's there and what we can do with it?
It is. There is a metric called API that measures somewhat how easy and how somewhat the quality of oil. This is a matter of volume and also quality. The Iranian oil is almost the sweet spot in terms of refinement, in terms of transportation, and Canadian oil is a bit heavier and takes more time to get processed, as we all know. While they can benefit from it, there's no real replacement for the Middle East oil compared to what we have in Canada. So yes, on the margin, it helps. It helps for the U.S., and we know we're exporting more than 90% towards the U.S. But we also have to be mindful of the risk of having internal demand consume some of that Canadian oil instead of exporting it. So it's somewhat limiting the impact of term of trade if we have to consume more oil because we were not able to buy oil from anyone else.
Okay, we have lots more to talk about this, but we have to go to a break. Coming up next, so we'll take a look at the markets before the bell. See how things are shaping up on the markets now. We'll start with U.S. futures, and it's all about the oil, of course. You can see the markets reacting, heading downward again today. The Dow starting, it's off by 1.1. NASDAQ not far behind it, and the S&P 500, there you go, just off by 1% right now. The major Asian markets, boy, oh boy, it was a volatile day there. Those numbers look good compared to the South Korean Kospi. It saw a circuit breaker triggered at an 8% drop. And that's about where it finished the day as well. You can see the Nikkei off by 5.2. It's always volatile. Hang Seng 1.35, and the CSI 300 down by 2.85. European markets won't be much better. And the FTSE off by 1.1 right now. CAC 40 by nearly 2. And the DAX off by 1.5. Off to the TSX now. Where did it finish the day on Friday? All the indices were in the red. Consumer discretionary, tech, industrials, all taking the biggest hits. Overall, it was off by 1.57. Who were some of the winners? There actually were some winners. We had to dig deep, but we found a couple. Aecon Group on a good earnings report, up 7.5. Constellation on their no deal, up nearly 6. Going the other way, Algonquin Power off by 11.5, and Methanex off by 13.4. And taking a look at the metals now, they are all off right now. But gold's still above 5,100, down by 1%. Silver off by about the same, a point, and it's at 83.50. And copper has been dipping. It's now down to 5.76. And of course, this is what everybody's talking about. Western Canadian Select on Friday closed up 12.5%, the differential. WTI tightening again. As for WTI, look at that. It's calmed down, if you want to call it that. It's still up 11%, but at one point this morning, it was up at nearly 120 a barrel. All right, as those oil prices continue to surge, our guest this hour, Hadiza Jatu, the Vice President and Portfolio Manager at Mackenzie Investments, has her eye on inflation. Recession is a word that's being bandied about, and says it's time to add duration incrementally to your hedge equity. To hedge equity risk in your portfolio is easy for me to say. We talked briefly earlier, talking about a recession, a global recession, and I guess the longer the oil is the prices stay up, the longer a recession could go if we do see it. How are you looking at things? How are you approaching the markets right now?
Yeah, when we look at the reaction and function of markets to this point has been somewhat expected, right? We have been seeing risk selling off. Mm-hmm. We've seen bonds also selling off on fear that inflation is going to pick up coming from the energy supply shock. But I think the next move is going to be, what does it mean for the global economy, right? So far, all the spots where we see, you were mentioning the Kospi has been down 8% and even more. It
was up by 20 in the 2 days last week.
Absolutely. Yeah. It is one of those inflated pockets of value. I mean, Kospi has been up 20% to your point. So you're seeing some kind of deleveraging of risk in spots that have excess positioning. And we will continue to see that. To me, we're not even in bear market territory when it comes to US stocks. So that is one threat in my view. Second one, when you look at the U.S. only, the latest labor market we got was extremely weak. We shed 92,000 jobs, and that is starting from a point where we're already somewhat in a weaker situation in the labor market. Mm-hmm. And now you have risk of inflation, but what inflation does, it picks up, and then it starts hindering demand. If you can't really buy goods because they're too expensive, you stop buying them. And that's where the global recession risk lies. And when you look at bonds, what do they do in your portfolio? Typically, when equities are down, bonds will go up because people will fly towards safe assets. Mm-hmm. And I know bonds have been challenged over the past few years, but we start to see some reaction that lead us to believe that it is actually, from an all-yield perspective, a really good entry point to add duration, to have that equity ballast in your portfolio.
Are there deals to be found in bonds? I mean, they're at lows that people haven't seen, right?
They are better than 2021 when they were around 1%. So they have risen back to, let's say, 3.5% in Canada, about 4% in the US. That is a coupon that you get. You're getting 4% out of, let's say, a bond that is worth 100 of capital. So that's mm-hmm. still good. It's actually better than most equity dividend yield, if you think about it. So you're getting paid, but you're also getting protection for being owning those bonds. And in this current environment, I'm really concerned about how things are going to unfold from here.
Well, and of course, the big thing down south of the border has been rate cuts. The push, Trump loves them. With this situation, though, I've now heard that we could see an increase down there.
I don't think they'll be able to cut this year, right? We have the inflation threat coming from the energy supply shock. We have tariffs. If you remember, mm-hmm. tariffs, Section 122 has risen tariff to 15% until 150 days, and then Congress needs to opine on that. But that is still adding some pressure on prices. And what we've seen last year that we don't have anymore for tariffs, last year, companies have built inventories. The effective tariff rate last year was about 8% because companies have front-loaded mm-hmm. and make sure that they have enough inventory not to hike price. But those inventories now are coming lower, and you will see, I think, more of the tariff inflation pressure. So definitely, to me, no cut rates. The only situation where I could see cut rates, and that would be a drastic scenario, and cut rates by 50 or 100 like we've seen in the past, mm-hmm. and if the world was plunged into a global recession, and they will come in and they will cut rates that they did in the past during COVID, notably.
And now the markets, I mean, I think the markets have kind of baked in that there were going to be probably 2 more rate cuts this year. What does that mean then?
2 rate cuts. The market always sees the Fed as a dovish central bank if you compare to Bank of Canada or even the ECB in Europe. So that is that dovishness that's priced in. And you remember all the chatter about who's going to be appointed next chair. There were some very dovish people that were contemplated. The Fed independence was questioned at some point. Kevin Warsh is obviously somewhere in the middle, but we know that he'll be pressured by the administration to cut rates, and that's what you see in those two cuts. And also the situation in the labor market. We've been in a low hiring, low firing environment for the past year or so in the US. We're not creating new jobs, and that is what the market is saying on the pricing into cuts.
And what about the Bank of Canada? Where do we sit? What do we do with everything that's unfolding right now?
The Bank of Canada is such an interesting spot. We went from pricing cuts to now hikes. So we have a couple, not a full hike, but close to 10 basis points hike before the end of the year. And that is coming from inflation, obviously. As I mentioned earlier, the Bank of Canada will have to lift the inflation forecast. Last print was about 2.5 if you look at the 3 median preferred measure, and 2.3 headlines. That's good, but that's not within the 2% target. It's still above the target, and now you're adding additional pressure coming from the energy supply shock. So they will likely not cut. They could potentially hike, but that is not my base case scenario.
Okay, we have to take a break there, but we'll be back with Hadiza Jatu, Vice President and Portfolio Manager at Mackenzie Investments, to see why mortgage renewals are on her radar. Time to see what's on the radar for Hadiza Jatu, Vice President and Portfolio Manager at Mackenzie Investments, and it's mortgage renewals that are catching your attention. Why are you focusing on that, Hadiza?
I'm focusing on that because about 60% of mortgage amounts in total are going to be renewed between they've been in 2025, and we have the kind of the 2026 also vintage. Past 12, 18 months, we're going to see all this renewal. Remember, those were locked in 2021, 2020 at maybe 2%, and now they're coming in terms of payment to almost be double when they get renewed. So that means for household, they're going to have to make choices, right? And if they make choices, it means consumption can actually take a hit. Discretionary consumptions, going out, going to dinner, etc. They're really, really going to be focusing on paying their mortgages. One interesting fact about Canada that's different from the US is if you default on your mortgage, the bank can not only go after your residence, but also beyond that, they can seize your RSP, they can seize your car. It goes really beyond.
They get their money.
They get their money, whatever it takes. And I think Canadians have that in mind, and they really make sure that they can pay. This is in context of an economy that is weak, right? We know that projected growth is 1% or so. It's very anemic. It's been very low. We're going into USMCA renegotiation. Business confidence is likely to take a hit, because I don't think Trump is going to be nice with Canada and say, oh, let's sign back and all go home. These are going to be long renegotiation that is going to hinder business confidence. And we know the real estate sector, what it stands. And lastly, net population growth is close to zero and projected to stay close to zero. And that's a key factor that drives the Canadian economy. Though really two-engine, real estate and immigration are literally stopped.
Yeah.
Then how can we pick up growth from here, especially?
And now throw in the potential of inflation with oil.
Exactly. And that's another layer of demand destruction. So that leads me to have a pretty bearish view on the Canadian economy, and mortgages are going to be an aggravating factor for that.
So the banks in many ways have to walk a fine line with this as well, because they don't want to see people walking, excuse me, they don't want to see people walking away from their mortgages. Yeah. It's not good for them either.
Absolutely, yes. But the Canadian banks, in fairness, have so far a very low delinquency rate on their mortgages. If you look globally for now, I don't expect those to really increase. This is going to hit, unfortunately, the low income bracket of the population, and that represent in amount less than, let's say, the bigger purchase item, the $2 million houses, et cetera, et cetera. But still, pressure on banks' balance sheet, but something that should be manageable. I'm more worried about the consumption side and how much it can hinder just discretionary spending.
I mean, we saw on Friday the consumer discretionary was down.
Yes.
And that sector was down, I think, 2%. Took a big hit on Friday. People are starting tighten the belts and think about what...
Absolutely. And we should see more of that as we go again into USMCA renegotiation, the inflation situation. That's going to be complicated.
And it's already been a struggle. I mean, restaurants, you talk to people. I don't go out anywhere near as much as what I used to because you get the sticker shock from the price.
Yes, and we've seen food inflation, right? We can see how much we're paying more at the grocery store when we go and buy foods, and people are now being more selective about what they're buying and giving up on certain discretionary spending that are not absolutely necessary. And that typically is something that crushed the economy. And again, I'm kind of worried. And the Bank of Canada, in that context, if we were to go into a global recession, we obviously will have to cut rates. They'll have to look beyond the inflation shock, because the inflation shock is going to be also coming down just because demand is being disrupted.
And I mean, people who have their mortgages coming up, should they take short term? Or is it just all over the place?
It's an interesting question. I would take a variable at this point, right? Because the chances of the Bank of Canada hiking, in my view, are limited. But if you go into a global recession shock, they're going to cut rates materially, and then you can benefit from lower rates at that point. But that's a hard question.
And there has been a bit of a disconnect, hasn't there, from the banks and the Bank of Canada? I mean, people automatically assume the bank drops its rate, the banks do the same, but it hasn't necessarily followed that in the last little while.
The prime rate has a lag compared to the Bank of Canada rate. So when they drop, there is typically a time lag. And also let's remember that the banks are also using hedging strategy when they do all the mortgage renewals, and those are not necessarily going to lead the consumer to benefit, let's say, from a lower 50 basis points cut if the Bank of Canada is cutting. It's a very indirect impact. Okay,
we have to take a break now, but we'll be back. Lots more to talk about, including the closure of the Strait of Hormuz is sending ripples across global markets, including Canada, and our phone lines will open soon for our first call segment. You can reach out at 1-855-326-6266. Send us an email, firstcall@bellmedia.ca. G7 finance ministers are set to discuss a possible joint release of strategic oil reserves as the Middle East war drives crude prices sharply higher. The call was organized by France, which holds the G7 presidency and could include coordination with the International Energy Agency. A release from global stockpiles could help ease supply disruptions that have pushed Brent crude close to $120 a barrel. It's now back down to about 102, still up significantly over the past 2 weeks. Officials say no decision has been made. Prime Minister Mark Carney and U.S. President Donald Trump spoke Sunday afternoon, according to a statement from Carney's office. The leaders discussed the economy, developments in the Middle East, and, of course, trade relations between the two countries. Both agreed to remain in close contact. Saudi Arabia has started reducing oil production as the near blockage of the critical Strait of Hormuz starts filling storage tanks. The cuts by the world's biggest oil exporter follows United Arab Emirates, Kuwait, and Iraq. Some of the countries have been turning production lower so as not to overwhelm storage facilities too quickly and avoid a complete shutdown. The near standstill, though, has clogged up exports, sending oil well above $100 a barrel and risking a spike in global inflation, maybe even a global recession. Taking a look at the markets, you can see they are off to get set for the week. Most of them right around the 0.9% mark down south of the border. And the war in the Middle East has all but closed the Strait of Hormuz. Here to give us some insight on that is Andrew Sire. He is an associate professor at the Department of Management at the University of Toronto and the Rotman School of Management. Andre, thank you very much for joining us today.
Hi, it's a great pleasure to be here. Thank you for having me.
It is an interesting time with this closure. I want to talk about it a little bit. Why are Canadian oil prices so affected by something that's only just happened, and yet we still have tons of oil here that we haven't used yet?
Yeah, absolutely. That's a great question. I think everybody's asking this at the moment. And indeed, Canada is a net producer of oil, of crude oil, and it's benefiting in some ways. You can see the price is also going to definitely benefit Alberta. But it is a paradox, it's a contradiction. What happens is that oil is a global commodity. And because it's a global commodity, it's going to be traded it's going to be traded by international benchmarks, international indices. You mentioned Brent. There is also the WTI. So even though we are exporting oil, we're definitely going to have to pay international prices for it, because in a way, also we are importer of oil. For example, we still need to buy refined oil from the U.S. around 30%. And we still need to buy internal oil for every purpose that we have here in Canada. So even though we are net producers, we just still need to import oil. We still need to buy international prices because it's a global commodity.
Professor, what's your view on the insurance system? There were chatter that there is potentially going to be government-led insurance to allow the ship to be carrying oil outside of Hormuz. How credible do you think that is?
I do think it's credible. I think there is a big effort we heard this during the weekend, I imagine, that the United States is willing to provide some insurance. Because what's preventing, one of the reasons that is the oil, the ships are not flowing through the Strait of Hormuz is because the insurance companies, they are reducing the level of insurance, they are reducing their what they can cover at the moment. And this is definitely one of the big blockades at the moment. So definitely there has to be a negotiation with insurance companies. And I believe it's credible. If the situation persists for longer, it's likely that there will be some effort there by countries such as the U.S. to help that situation with insurance companies for sure.
And if the U.S. does do that, where does that leave the insurance companies? I mean, they don't want to send ships that run the risk of sinking and the disaster that would be. And I know they wouldn't have maybe be on the hook for the coverage of it, but they'd still be involved in this.
Right. So I must say that this has not yet been very well defined, right? There's still rumors and it's really complicated now to know. There's so much uncertainty, so many different levels in terms of the insurance. We only know that there is some discussions now. How is that going to work? I would imagine, if I were to speculate, which is a big mistake of my part probably, is that this would be a temporary solution. And definitely it's just to make sure that some flow is going out of the Strait of Hormuz for sure.
What's your view? So Hormuz is about, let's say, give or take 20% of global production of oil on a daily basis, right? So what do you think the GSET reserve, strategic reserve, can make up of that? My view is that it's not going to be sufficient, but you're the expert. So do you think it at least give us a few days, a few weeks in terms of supply?
Absolutely. There will definitely be... So when we think about markets, right? So we are in the situation now where we are cutting supply very aggressively because of the Hormuz closure. Virtually it's closed, right? It's 80% of 80% reduction in capacity, and we have still demand at the same levels that we had before. So by putting more oil into the market, by providing the supply from the reserves, we can maybe improve supply a little bit so that we can try to reduce those costs. Now, I think that it can work temporarily, right? For sure, it can help reduce the price temporarily, but it always depends on how long this war, how long this conflict will continue. So if it continues for a long time, I agree with you, then it's going to be complicated. We're going to deplete our reserves. Another thing that can happen is this country is also going to start looking for other markets. For example, maybe Canada can help there. The only issue is that the consumers here in Canada would also suffer, right? Because we're going to export more of our oil. But at the very least, we know that Canada is this countries, they're going to look for more stable countries like Canada, where they can have some stable supply. So I agree with you. It would be a temporary solution. It would definitely help reduce some of the anxiety that we are experiencing. But in the long term, I'm not sure if this is the optimal solution.
And you mentioned with Canada being a possible source, but they also are going to look and go, Canada can't really supply Canada. We don't have the capabilities right now to get any more out of the ground, do we? Or minimal more?
Absolutely not. So Canada, as you know, we are on the west, we are big producers of oil, Alberta, as everybody knows. And on the east, we are just big consumers, right? We have Ontario, Quebec, everybody wants to consume those oils. And it's surprising that it's cheaper to import oil from the U.S. It's, 30% is easier to import oil from the U.S. than from Alberta, and also refined products and refined oil products, derivatives, and so on. So we do not have the capability, and something that we have been discussing this last few years. And I hope this brings this discussion back to the top of our minds of how can we integrate the provinces, for sure.
And just how long would this have to go on in the Middle East and the Strait there with the shutdown for Canada to actually benefit, where people would turn to Canada and take a look? I mean, because a lot of people, I think, are looking, this could be over in 2 weeks, could be over in a month. How would it have to go? Would this have to go a year, and then people would start to want to invest in Canada with this?
I think because it would not be short. It would have to be a few months. I'm not sure if it's a year. It's just too hard to estimate at this moment. Mm-hmm. But it's a structural change, right? So it would have to take some time. And everybody's not... I think there is a sense now of not taking risks, because we hear from the U.S. administration that this would be limited in time. It's not going to be months, but at the same time, we hear rumors that it would take a long time. So it's similar to the tariffs, right? Everybody's concerned, oh, should I build the factory here or not in the U.S. because I don't know if the tariffs are going to remain the same, going to increase. Somewhat the same. We don't know whether the oil price is going to stay that high for so long. It is not good for multiple reasons that it doesn't, because, for example, we are cutting supply to Asia by 70 to 80%, right? Japan is heavily dependent on the oil from the Gulf states. So we're going to start feeling the impact on multiple different products. So I don't think it's going to be hard for them to make the decision. Let's just change to Canada or to other countries. But I think it would have to be like this for a long time.
Okay. Andre, we have to leave it there, but thank you very much for joining us.
Thank you. It was a pleasure.
Cheers. Andre Syria is an associate professor at the Department of Management at the University of Toronto and the Rotman School of Management. Still ahead, today's market drivers with Bloomberg's Divya Balji. And, of course, our phone lines are open. Hadiza Jatu, Vice President and Portfolio Manager at Mackenzie Investments, is taking your questions on the Bank of Canada, inflation, and the dollar. Call us at 1-855-326-6266. And you can also email us, first call at bellmedia.ca. All right, let's take a look at some early market movers, and we're joined by Bloomberg's Divya Balji, managing editor for breaking news in the Americas. Divya, thanks as always for joining us. Hims and hers out there getting in on the weight loss. What's happening with that?
Yeah, I think you can call this a classic case of from enemies to BFFs, or maybe even just partners in this case.
Or frenemies.
If you recall back in... Yes, or frenemies. That might even work as well, actually. If you recall back in February, they were sued by Novo Nordisk for coming out with a copycat pill to Wegovy, and wanting to sell it on their platform. And, they dropped that suit, Hims and Hers said they won't sell it. And now it seems like they have this partnership where Hims and Hers is going to sell Novo Nordisk's Wegovy pill on their platform, which might actually be good for both companies. It is certainly a huge revenue stream for Hims and Hers. It will also be a new avenue in terms of where Novo Nordisk can sell their Wegovy pill. As we all know, Novo Nordisk has had quite the challenging year so far in terms of Eli Lilly really coming in and taking a lot of their market share, and also them coming up with secondary weight loss pills that haven't worked out so well based on studies that we have seen. So Hims and Hers up about 40%. I believe last I checked, Novo Nordisk was also up a little bit. So far good news, but it's a highly volatile situation as we've seen in the last few months between both companies. So we'll see where this goes.
All right, and we've got a new plot twist for Warner Brothers Paramount. Just when we thought it was done, a sequel.
Yeah, yes, exactly. I just feel like this is never going to be done, and we've talked about that quite a bit. There's probably going to be a Netflix show about all of this, but or a Paramount show in this case. I think in this case, Tencent actually owns a stake in Paramount. And, originally as part of this deal, it was going to invest $1 billion in this deal as well. Now, that sort of raised a lot of concern with Warner Brothers, having a Chinese company come in and take on a major stake, possibly even have some kind of rights over the company. That was an issue. I think there was that concern. And now they've come back saying, there is this possibility of them investing hundreds of millions of dollars purely as a financial partner, which makes it sound like maybe they won't have any sort of rights as to making controlling decisions. Now, there's still a lot of unknown here. Is Tencent actually going to make this investment? How much is that investment going to be? Is it going to be $999 million or is it going to be $200 million? I think that makes a big difference. Now, once we know that amount, are U.S. regulators going to come out opposing this deal because of that or saying it's okay? We've seen a lot of stuff happen with TikTok, recently. Could this possibly go down that way as well? So a lot up in the air at this point. It really comes down to how much Tencent is going to invest and what exactly it gets from investing in this deal.
All right. I think I'm going to wait for the book. Divya, thank you as always.
Thank you.
Bloomberg's Divya Balji. Well, there's been a lot of buzz about humanoid robots lately aimed at helping in the home. This is all part of a robot revolution powered by AI that an Ontario company is part of, using its own made-in-Canada machines and hoping for more domestic investment. CTV's John Benavali Rao has more.
So this is MH3. This is our third generation humanoid.
Tarek Rahim was happy to show us his company's most recent humanoid, a made-in-Canada machine with arms, hands, and a head.
But this is purely Canadian.
100%, yes.
Developed in Cambridge, Ontario by Mercy Robotics, the goal is to start putting the so-called MH3 to work next year, initially doing repetitive and mundane jobs in industrial settings. The robot has vision and can locate and lift objects like this water bottle, placing them precisely where they need to go.
And that sounds simple, but it's actually very technically challenging to pull off.
And amid an explosion of AI-driven advancements, Rahim thinks something bigger than the automotive revolution is about to hit.
I can't wait for what's coming ahead. It's really exciting.
Recently, Kung Fu robots in China became a viral sensation, a flashy example of how fast the technology is moving. There have also been test projects with humanoids in the home, though many still need guidance from operators off-site. And it was recently announced that several of these people-like robots will begin working at a Toyota assembly plant in Woodstock, Ontario. They were built by a company based in Oregon.
It has been wild. The amount of interest and investment and competitors that have just emerged in the last 2 years has been mind-blowing.
Rahim has been working on robots for almost a decade, starting with this earlier humanoid, and now arriving at a third version that notably doesn't have legs.
Why not legs?
So legs actually don't make a whole lot of sense. They chew through power just standing, and they're inherently unstable, whereas wheels give you triple the battery life, and you cannot easily knock this guy over.
Mercy has around 10 employees, but plans to double that. All of the major components are built in Ontario. And with China surging ahead, Rahim thinks the federal government should do more to support the sector.
Now we're just seeing this tremendous growth because of all the interest in the industry.
With Mercy hoping to mass produce its own robot in the coming years. John Benavali Rao, CTV News, Cambridge, Ontario.
Still ahead, we'll take a look at some of the notable analyst calls and recommendations moving the markets, including a Barclays analyst who is upgrading their recommendations on European airlines. Let's take a look at some of the notable analyst calls and recommendations. Shares in European airlines should rebound from their ongoing steep losses when the air campaign over Iran ends, bringing relief to fuel prices, Barclays analysts say, upgrading their recommendations on IAG, Lufthansa, Air France, and Finnair. A UBS basket of European airline stocks is down 4.3%, trading at the lowest level since June. Now, there is uncertainty over when fuel prices will peak and how long they will remain elevated, but waiting for oil to drop will leave us too late to capture the potential rebound of airline shares, writes analyst Andrew Lobenberg. Lufthansa, Air France, and Finnair are all upgraded to equal weight from underweight, while IAG is raised to overweight from equal weight. When we come back, Hadiza Jatu, Vice President and Portfolio Manager at Mackenzie Investments, will take your questions on First Call. All right, time for First Call and first email. This one is from Ashley, and the subject is, with interest rates elevated and many borrowers approaching renewal windows, what is your base case outlook for rates over the next 12 to 18 months, and how should households prepare for potential payment resets? All right, Hadiza. That's in your wheelhouse.
That's a fantastic question. I'll give you my base case scenario, and I'll give you an alternative scenario. Base case scenario for me is Bank of Canada may potentially cut rates towards the end of the year. Remember, we started discussion about mortgage renewals and the burden it could bring on consumption. We have real estate that is not starting over. We can see all the headlines with how little transactions are made in Ontario and GVA, which are kind of the big epicenters. And the population growth is a big thing to me, because we went from 3% population growth annual to 0. And immigration is such a boost for consumption because it's instant, right? People come in, they start renting, they buy food, they buy furniture. It's really span across different sectors. And we have completely removed that. So that's why I could see lower rates by Bank of Canada. Now, the one part of the curve that really makes me a bit more nervous is the long end of the curve. So long end of the curve typically will price in potential fiscal deficit. If this situation in Iran continues and the energy supply shock really trend into a growth scare across countries, it means that the government is going to have to step in and support people. And if that happens, markets are going to start really getting worried about the long end of the curve and spending and borrowing, and that you can see actually the long end of the curve, not only in Canada, but across country. But I would say I could see a cut. Now, what is the alternative scenario? Is the Rousseau story start really picking up? Carney get to a point where he negotiates with other partners where we can export oil, diversify from the U.S., and you see really growth starting to pick up, and that supports consumption. In that case, there's no case for Bank of Canada to cut rates.
And this, like what's going on with the U.S. could be good for Canada because it's forcing us to rethink how we do things, isn't it?
Yes, this is the perfect timing if you think about it. We know that Carney gave a pretty amazing speech in Davos. He's showing willingness to diversify from an over-reliance from the U.S., and this energy shock now can actually portray Canada as one of the biggest beneficiary. And a lot of people, market people that I speak to, see Canada a bit more constructively from that perspective.
And they like stability, and that's one of the things we provide.
Absolutely. Right? Safe haven. Canada has been seen by foreigners like safe haven. Back in 2008, when I was working in Europe, we were buying Canadian banks because they were the only one not blowing up with subprime and other things. So that idea of high quality, solid, is really supporting Canada also in that environment.
All right, let's get to another email. This one's from Emma, and it says, given the current macro backdrop, what are the key factors you believe the Bank of Canada will be most sensitive to in its upcoming policy decisions? Growth risks, inflation persistence, or financial stability considerations? Or, I'm going to add one, all of the above.
All of the above, indeed, but maybe in a different rank of order. Bank of Canada is an inflation fighter, right? It's been the one bank that has consistently surprised the market in their ability to be hawkish and just hiking rates because they believe inflation is picking up. So to me, they're still going to put that mandate really on top of the list. But if inflation is, let's say, okay, within the 2.5, 2.7 level, they will allow themselves to cut if they see that really the economy is struggling and those mortgage renewals are becoming a threat for a growth that is already so anemic. And I would say they might bend a bit the perception on it. Last, the January MPR report that we show had a level of inflation that was absolutely okay, and growth was a bit lower, and that to me signaled that they are open, not saying that they have committed to, but they are open to see how the data evolves, and if the data evolves into weakness, they could potentially cut rates.
Okay, let's get one more email in here. It's from Jess. In a world where global central banks are diverging, how sensitive is the Canadian dollar to changes in the Canada-U.S. rate differential versus crude prices right now? We are benefiting right now, or at least the dollar is benefiting.
Yes,
right
we are. So typically you have a crisis, US dollar is stronger. I also believe that Canadian is actually outperforming today G10 currency because of the oil term of trades, and a rate differential with a Bank of Canada that is, let's say, on hold or cutting, and a Fed that to me is not going to cut. If you look at the impact of this energy supply shock on just the core PC, which is the preferred measure of the Fed, we're going to add 30 cents, 0.3% to the March CPI, just because gasoline prices are up about 10%. They account about 9% in the calculation of the PC, not the core, but the PC. So that says higher inflation in the US, Fed not necessarily cutting, Bank of Canada already in a weaker spot. So you're going to have this interest rate differential actually widening, and that should be, all things getting equal, negative for the Canadian dollar.
Okay, we'll wrap it up there. But Hadiza, thank you very much for joining us today. We appreciate it.
My pleasure.
All right. And that is it for us here on The Street. Again, thank you to Hadiza Jatu, Vice President and Portfolio Manager at Mackenzie Investments, for joining us today. Andy's up next with the Open. Trading gets underway in about 30 minutes. Hold on to your hat for it. Have a great day.